Friends, thank you for being here today. What if I told you that while the news was celebrating a historic year for the stock market, the very plumbing of our banking system was quietly seizing up behind closed doors? What if the safety of your retirement savings wasn't determined by the visible numbers on your screen, but by a frantic midnight scramble for cash that the Federal Reserve hoped you wouldn't notice? We often look at the economy like a weather report, checking the surface temperature, the highs and the lows of the Dow Jones or the S&P 500. But the real weather, the storms that shape our financial future, happens deep in the atmosphere and the complex unseen machinery of the banking system. And on December 31st, 2025 and January 1st, 2026, that machinery ground to a halt in a way we haven't seen since the great lockdowns of March 2020. Today, we are going to walk through exactly what happened during those critical 48 hours. We are going to strip away the jargon and the headlines to look at the raw data. Because the story isn't just about a glitch in the system, it is about a fundamental shift in how the United States manages its debt, its currency, and ultimately your wealth. We are seeing a paradox. On one side of the ledger, we have banks parking record amounts of cash at the Federal Reserve, seemingly awash in liquidity. On the other side, simultaneously, we have banks begging the Fed for emergency loans at penalty interest rates. How can the system be drowning in cash and starving for it at the same time? The answer lies in a concept called window dressing, a crisis in the silver markets, and a much larger, longer-term plan to overhaul the global financial system through tokenization. This is not just a market fluctuation. It is a signal, a flare, sent up from the engine room of the economy, telling us that the old ways of managing liquidity are breaking down, and a new digital architecture is being hurriedly put in place. So I ask you to settle in. We are going to treat this with the seriousness it deserves, examining the facts, the statistics, and the events without hysteria, but with a clear-eyed view of what this means for our nation, stability, and for your personal prosperity. To truly grasp the mechanics of this failure, we must first understand a concept that sounds benign but masks a deceptive reality known as window dressing. Imagine, if you will, a teenager's bedroom. It is a disaster zone. Clothes on the floor, pizza boxes stacked in the corner, chaos everywhere. Suddenly, the teenager gets a text. His parents are pulling into the driveway and will be up to inspect the room in 2 minutes. He doesn't have time to actually clean the room. He doesn't have time to do the laundry or take out the trash. So, what does he do? He grabs everything, the mess, the contraband, the clutter, and he shoves it all into the closet. He slams the door shut and leans a chair against it. When the parents walk in, the room looks pristine. The inspection is passed, but the mess hasn't gone away. It has simply been hidden. This is exactly what happens in our banking system every year on December 31st. The fiscal year ends, and at midnight, banks must take a snapshot of their balance sheets to show to regulators. This snapshot determines their capital reserves, their leverage ratios, and their risk exposure. It is their report card. If a bank is holding risky positions or is over-leveraged, they cannot afford for that to be seen on the permanent record. So they engage in window dressing. They move dollars around, they reduce leverage, and they hoard cash to make their liquidity coverage ratios, or LCR, look healthy. But this year, on New Year's Eve 2025, the closet door wouldn't close because the mess was simply too big. We saw this most vividly in the silver market. Now, I want to be very precise with the numbers here because they tell a startling story. In the final hour of trading on December 31st, silver was trading near a robust $83. It had been a historic run. But suddenly, in those final 60 minutes, the price collapsed. It dropped 5%, plunging from around $83 to close at exactly $71.30. Now, the mainstream financial media will tell you this was profit-taking. They will say traders were simply cashing out after a good year. But does profit-taking look like a vertical cliff dive? Does a gradual unwinding of positions result in a 5% crash in less than an hour? No, that is not profit-taking. That is a liquidation event. We have received reports from private commodities, analysts, and dealers that paint a very different picture. While your computer screen showed silver at $71.39, physical silver in Tokyo was trading at $130. In Kuwait, it was trading at $106. Think about that for a moment. If you cannot buy a physical ounce of silver for $71, is the price really $71? Or is that just a number on a screen divorced from reality? This $30 to $60 spread between the paper price and the physical price is unprecedented. It suggests that the paper market, the digital representation of silver, was manipulated downward to save a major player from insolvency. Here is the thesis, supported by the data. A major financial institution had built a massive short position in silver, likely around 600 million ounces, betting that the price would fall. When silver instead rallied to $83, that institution was underwater. They were facing billions in losses. If they had marked those positions to market at midnight on December 31st, they would have been technically insolvent. They would have failed the inspection. So they liquidated. They dumped their position, forcing the price down to 71.39, just low enough to make the losses look survivable on a balance sheet. But here's where the smoking gun appears. You could not just dump a position of that size without massive amounts of cash to settle the trades and meet margin calls. You need liquidity. And where did that liquidity come from? At the exact same time silver crashed, the Federal Reserve injected $31 billion into the market via overnight repo. Let's do the math. If an entity is short 600 million ounces and the price moves against them by roughly $53 from an entry of $30 to the peak of 83, they are looking at mark-to-market losses of nearly $31.8 billion. Add in fees and settlement costs, and the whole is roughly $35 billion. The Fed provided $31 billion. The loss was roughly $35 billion. The numbers are nearly identical. This was not seasonal housekeeping. This was a bailout. This was the Federal Reserve stepping in to provide the cash needed to close the closet door, to ensure that a catastrophic trading loss didn't cascade into a systemic failure right before the regulatory snapshot was taken. Now that we have seen the specific mechanism of the bailout in the metals market, we need to widen our lens to the broader banking system because the instability runs much deeper than just one commodity trade. We need to look at the repo market. I know repo sounds technical, but simply think of it as an overnight pawn shop for banks. If a bank has treasury bonds but needs cash to pay its bills tonight, it goes to the repo market. It gives the lender the bond, collateral, and gets cash, promising to buy the bond back tomorrow for a slightly higher price. That difference in price is the interest rate. On December 31st, 2025, this market exploded in two contradictory directions. First, let's look at the Standing Repo Facility, or SRF. This is the Fed's emergency lending window. You only go here if you absolutely cannot find cash anywhere else. It is the lender of last resort. On New Year's Eve, banks tapped this facility for a record $74.6 billion. Let's break that number down. To get this cash, banks had to pledge collateral. They pledged $31.5 billion in U.S. Treasuries and $43.1 billion in mortgage-backed securities. Why does this matter? Because borrowing from the SRF is expensive. The interest rate is 3.75%, which is the upper bound of the Fed's target range. It is a penalty rate. No bank wants to pay the maximum price for money unless they are desperate. The fact that banks demanded nearly $75 billion at this penalty rate tells us there was a severe shortage of cash in the private market. The plumbing was dry. But here's the paradox. While banks were begging for $75 billion in cash at the emergency window, other institutions were flooding the reverse repo facility, RRP, with cash. The reverse repo is the opposite. It's where you go when you have too much cash and nowhere safe to put it. You park it at the Fed overnight to earn a small bit of interest, currently 3.5%, the lower bound. On the exact same day the SRF hit a record, the reverse repo exploded to $106 billion, a 5-month high. So pause and consider this image. One line of banks is desperate for cash, paying a penalty to get it. Another line of institutions is drowning in cash, accepting a lower rate just to park it safely. Why aren't the banks with the extra cash lending it to the banks that need it? That is the fundamental function of a banking system, matching savers with borrowers. When that stops happening, it means one thing: distrust. The banks with the cash did not trust the banks that needed the cash. They were worried about counterparty risk, the risk that the other guy won't pay you back tomorrow morning. They would rather earn less money parking it at the Fed than risk lending it to a fellow bank. This bifurcation, this split between the cash rich and the cash poor, is a classic sign of a broken interbank lending market. It is the same dynamic we saw in 2008 and in September 2019, and we can see this stress in the interest rates themselves. The Secured Overnight Financing Rate, SOFR, which measures the cost of borrowing cash overnight using treasuries as collateral, breached the Fed's upper limit of 3.75%. When the actual cost of money in the market rises above the price the Fed sets, the Fed has lost control. It means the demand for dollars is overwhelming the supply. And why is supply so low? We must look at quantitative tightening, QT. Since the peak in late 2021, the Federal Reserve has been shrinking its balance sheet. They have destroyed bank reserves. Reserves have fallen from a peak of $4.2 trillion down to approximately $3 trillion. That is, over $1 trillion of liquidity sucked out of the system. On top of that, the U.S. Treasury has been rebuilding its checking account, the Treasury General Account, TGA. This account now holds nearly $1 trillion. Every dollar in the Treasury's account is a dollar that is not in the banking system. The Treasury needs this massive buffer because they are facing $600 billion in T-bill redemptions every 5 days. They are running on a treadmill of debt, constantly paying off old short-term loans with new ones and hoarding cash to ensure they don't default. So, we have the Fed destroying money the Treasury hoarding money, and banks refusing to lend to each other because of hidden solvency issues like the one we saw in silver. It is a perfect storm for a liquidity crisis. Now, friends, if this were just a temporary glitch, we could perhaps shrug it off, but the actions being taken by the highest levels of government and finance suggest this is the catalyst for a much larger change. We are moving toward a great financial reset, specifically through the tokenization of assets. You may have heard of Larry Fink, the CEO of BlackRock, the world's largest asset manager. He has been telling us for years that the next generation for markets is the tokenization of every financial asset. What does that mean? And why is it being pushed now amidst this liquidity crisis? The current system, the plumbing we use to settle trades, is outdated. It takes time to move money. It takes time to settle a stock trade, T+1. In a crisis, that delay is deadly. Capital gets trapped. Tokenization places assets, stocks, bonds, real estate, even the dollars in your pocket, onto a blockchain. It turns them into digital tokens that can be traded instantly, 24/7, with perfect transparency. But there is a more strategic, geopolitical reason for this shift, and it directly concerns American economic sovereignty. We are facing a systemic lack of demand for U.S. debt. Foreign nations, particularly those in the BRICS alliance, are buying fewer U.S. treasuries. Some are even dumping them. This is a threat to our national security. If we cannot sell debt, we cannot fund our government or our military. Enter the Genius Act and the Clarity Act. These pieces of legislation are not just about crypto. They are about reshoring our debt. The U.S. government is pivoting to encourage the creation of stablecoins. A stablecoin is a digital dollar, but to exist, it must be backed one-to-one by safe assets, specifically short-term U.S. treasuries. Do you see the brilliance of the strategy? If the entire world starts using U.S.-regulated stablecoins for commerce, the issuers of those coins, companies like Circle or Paxos, must buy trillions of dollars of U.S. treasuries to back them. This shifts the ownership of our debt. Instead of the Chinese central bank or the Saudi central bank holding our debt, entities that can weaponize it against us, our debt will be held by private American companies under the strict supervision of U.S. regulators. It pulls global demand for dollars into a domestic regulatory perimeter. It secures the demand for our debt by digitizing the dollar. This is why we are seeing the SEC suddenly drop cases against crypto firms like Ondo Finance. It is why the hostility of the previous administration, characterized by Operation Chokepoint 2.0, has vanished. The government realizes it needs this technology. It needs the liquidity. It needs the velocity of money that tokenization provides to keep the system afloat. However, this transition comes with risks for you, the taxpayer, and the retiree. First, the easing of financial conditions signaled by the Clarity Act and the end of the crypto crackdown is inflationary. When you make it easier for money to move and easier for credit to be created, you increase the money supply. Markets are already anticipating this. That is why we are likely to see long-term bond rates rise. Investors are demanding a higher return to protect against the future inflation they know is coming. Second, we are in a dangerous transition period. We are walking a tightrope between the old dying system and the new digital one. As we move into the first week of January 2026, the closet door that was slammed shut on New Year's Eve must open again. The banks cannot hide their bad positions forever. The window dressing period is over. We need to watch the data like hawks. Will the usage of the Fed's emergency repo facility drop back down to zero, or will it stay elevated? If banks continue to borrow billions from the Fed next week, it confirms that the insolvency wasn't just a one-night problem. It confirms that the patient is on life support. And what about the silver market? If that price disconnect remains, if silver stays at $71 on your screen but costs $130 to actually hold in your hand, it tells you that the paper market is losing its ability to set the price. This leads to a crucial realization for every American protecting their wealth: the difference between paper value and physical value. In a tokenized world, everything is digital. But in a crisis, as we saw with the silver squeeze, the only thing that matters is what you can physically access. The institutions saved themselves by manipulating the paper price, but they could not conjure physical silver bars out of thin air. The shortage remained real. To understand the magnitude of this moment, we must look back at our history. This is not the first time the United States has fundamentally altered the nature of its money to solve a debt crisis. In 1933, under the pressure of the Great Depression, the government confiscated gold from private citizens and devalued the dollar. In 1971, facing a run on our gold reserves by foreign nations, President Nixon suspended the convertibility of the dollar into gold, effectively birthing the modern fiat currency era. Now, in 2026, we stand at the precipice of the fourth great monetary turning. But unlike 1933 or 1971, this shift is not being announced with a presidential address from the Oval Office. It is happening in the shadows of the repo market and through the complex language of legislation like the Genius Act. The goal, however, remains exactly the same: to keep the government funded when the natural demand for its debt has dried up. Think about what this means for the purchasing power of the dollars in your pocket. When the Federal Reserve and the Treasury coordinate to backstop the bond market and encourage the creation of tokenized dollars, they are essentially prioritizing the system over the currency. They are ensuring that the pipes of the financial system remain full of liquid cash, even if that cash buys less and less at the grocery store. This is the invisible tax that is levied on every saver who plays by the old rules. In previous decades, you could rely on the interest from a savings account or a treasury bond to outpace inflation. But in this new regime where liquidity is manufactured to save institutions, real yields are often negative. The cost of living, the price of energy, food, and healthcare rises faster than the safe return on your capital. This is why the window dressing we witnessed is so insidious. It masks the true condition of the dollar. By hiding the insolvency of the banks, they are also hiding the devaluation of your labor. We must also consider the international implications. For 50 years, the United States enjoyed an exorbitant privilege because the world needed dollars to buy oil. That era is fading. As rival nations trade in their own currencies, the U.S. is forced to manufacture its own demand. That is the true purpose of the stablecoin push. It is a desperate bid to digitize the dollar and force it into the crevices of the global digital economy before competitors can take hold. It is a geopolitical strategy masquerading as financial innovation. But here's the catch for the patriot. While this strategy might preserve American hegemony on the global stage, it requires the domestic population to absorb the volatility. The spikes in the repo market are the tremors of this adjustment. And who pays the price for the adjustment? It is not the hedge fund manager who gets bailed out by the reverse repo facility. It is the retiree on a fixed income who watches their purchasing power evaporate. This historical context is vital because it strips away the fear of the unknown and replaces it with the clarity of precedent. We have been here before, and we know that in every monetary reset, wealth is transferred from the passive to the active, from those who hold paper to those who hold real assets. I would love to hear your thoughts on this. Do you believe these fundamental economic shifts and the move toward tokenization will ultimately strengthen or weaken the American middle class? Let us discuss it in the comments below. This brings us to a critical juncture where we must ask the hard question. What does this strategic pivot mean for the kitchen table economics of the average American family? We are witnessing a profound decoupling between the strategies of Wall Street and the realities of Main Street. While the architects of this new system in Washington and New York are focused on liquidity velocity and reshoring debt, American families are left grappling with the downstream effects of these high-level maneuvers. The first pillar we must reinforce in our own lives is true fiscal responsibility. For decades, we have watched our government operate with a complete disregard for balanced budgets, relying on the printing press and complex financial plumbing to paper over deficits. The events of New Year's Eve, where billions were conjured overnight to plug a hole, demonstrate that the system relies on an addiction to debt. But here is the hard truth. You cannot manage your household the way the Federal Reserve manages the economy. You cannot print your way out of a shortfall. As the nation transitions to this new digital collateral system, the government is effectively signaling that it will prioritize system stability over the purchasing power of the dollar. This makes personal fiscal responsibility, living within means, eliminating variable rate debt, and securing fixed assets, an act of patriotic defiance. This leads directly to economic resilience. We talk often about American resilience, the grit that built this country. But in 2026, resilience requires more than just hard work. It requires strategic positioning. The window dressing we expose today reveals that the institutions we trust are often presenting an illusion of health. If the banks are hiding their mess in the closet, you must ensure your own house is in order. This means recognizing that American prosperity is being redefined. It is no longer about the illusion of wealth created by credit. It is about the sovereignty of ownership. The move toward tokenization and stablecoins is an attempt by the U.S. to export its inflation to the world. But as we see bond yields rise, that risk is coming home. To be resilient, the American retiree must look beyond the paper promises of a 60-40 portfolio and understand that in a liquidity crisis, the only asset that matters is the one you own outright, with no counterparty risk. Finally, we must protect the core of American prosperity, our independence. The push to bring all debt under a domestic regulatory perimeter through stablecoins is a double-edged sword. Yes, it secures the nation against foreign dumping of bonds, which is vital for national security, but it also centralizes control. A tokenized dollar is a trackable, controllable dollar. As patriots, we want a strong America, but we also want free Americans. The Clarity Act and the Genius Act are sold as tools for efficiency, but they are also tools of surveillance. True prosperity involves the freedom to transact in the privacy of your wealth. As this digital curtain falls, maintaining a portion of your wealth in tangible, non-digital assets, like the physical silver that commanded such a premium in Tokyo, is not just an investment strategy. It is a vote for personal liberty. We are entering a period where the government is rewriting the rules of money to save itself. You must rewrite the rules of your household economy to save your family. So, when we step back and look at the events of those 48 hours, the warning shot becomes unmistakable. The record $74.6 billion in emergency borrowing, the $106 billion spike in reverse repos, the $31 billion injection to bail out a silver short. These are not signs of a healthy free market economy. They are the spasms of a system that is being managed, manipulated, and transitioned in real time. We are witnessing the end of an era of traditional banking plumbing and the painful birth of a tokenized financial system. This transition is designed to save the U.S. Treasury market, to reshore our debt, and to maintain American financial dominance in a digital century. But for you and me, the lesson is clear. Do not be lulled to sleep by the headlines of a historic year. Look at the plumbing. Look at the liquidity. Understand that when the system seizes up, the rules change overnight to protect the institutions, often at the expense of true price discovery. Stay vigilant. Watch the repo numbers this week. Watch the spread between physical and paper assets. And remember, in a world of digital illusions, tangible reality is the only true safe harbor. Thank you for your time today. If you found this analysis valuable, I invite you to like and subscribe to join our community of informed citizens. May we all navigate these changing tides with wisdom and prudence.